What's doing the best is the Hong Kong market right now. It's around 0.5% higher.
With a possible negative headline number, and it would join other private sector data we've been following and suggesting some easing in inflation.
मैं आपको बता दूं कि कोई demolition का कोई भी जो है यहाँ पर order नहीं हुआ है.
They've downgraded the rating to sell from reduced.
The Nifty holding above the 17,900 mark.
Heading into this year, macro is expected to slow down.
In terms of equity markets, we actually remain fairly bullish on the longer-term prospects.
I think the Jimny is looking a little cool. You know, the one in the yellow out there that's up for you on the screen. I don't know whether it's going to be a bit of a competition to the Thar and the likes.
As we speak, we're down 70 points on the Nifty.
Axis Bank is likely to propose a price of 85 rupees per share for the acquisition of that 7% stake in Max Life Insurance.
I think to address the challenge of climate change, the whole world is moving towards net zero greenhouse gas emissions.
To be 5.85% inflation. That's important because it's below 6.
The Nifty is now trading below that 17,800 mark.
Well, that was the day so far. Hello and welcome to Closing Bell, live from the CNBC-TV18 Motilal studios. I'm Prashant. With me in the studios, my colleague Reema, and from the newsroom, we have Nigel. Guys, hi, good afternoon.
Hi.
It's been a big day with the big fall and then a big recovery as well. And we are starting the program as we are in the throes of that recovery. So, you know, the market broke through the December 26th low, but briefly, 17,774 was that number. I think the low today has been made at about 17,761. So you can, you know, numbers are numbers and we've broken through. So when tomorrow we talk about lows, today's low comes into play. But many times when you're talking about these swing lows, what matters is what happens by close. And for now, you know, you've basically seen a bit of a bounce. Now, there's a full 60 minutes to go and a lot could happen, but it's looking a little better as compared to, say, an hour ago or so. I think one big reason why the market has been looking iffy is Reliance Industries. I mean, we've all been focused on banks and, you know, the banks underperforming, outperforming and all over the place, but RIL is a big drag. Actually, 10 minutes ago, about 45 index point pressure was coming in from just Reliance, 41 now. So that is a big one. And it's been underperforming for a while. It's broken through some levels. I think there is a head and shoulders pattern there. We can probably present the chart later on. But that is a perhaps a pain point for the market, not just now, but you know, if the structure does not improve, it's got a huge weight for the future as well. The big data point which can swing things really is the US consumer price inflation number. That is later today. The consensus is seeing core inflation growing about 0.3% month on month. We've had big reactions, mind you. I mean, in the past, on the basis of what the CPI number is. Most often than not, if you look at the last 2 or 3 prints, you know, it's been very, so immediately after, if the inflation print is much weaker, the market rallies, but then it quickly fizzles out. Even when the inflation number has been, you know, much higher, the market does fall, but then, I mean, you know, it's stalled after that. In the US, we've had the NASDAQ, which is already up 10% very quickly going into the CPI number. So I think this becomes all the more important. We've got a little bit of comfort here in India. I mean, imagine, for example, we come back tomorrow and the number is a big positive, which is that the inflation number is much weaker than expected. I think we have the comfort of the fact that in the very near term, over the last fortnight or so, the market here is done poorly as compared to, say, what the US has done or other markets have done. So maybe there is a bit of room, provided the data sort of works out that way. So we'll find out, but that's the one to watch out for. Reema, hi.
Hi. So this number, US CPI inflation print, will be out at 7 p.m. India time, 8:30 a.m. US time. But for India, it will be 7 p.m. India time. And there are reports that US President Joe Biden will be speaking 90 minutes post the US CPI print. Remember, Joe Biden had also spoken post the release of the November print, which had come on 13th of December. And at that time, he had said, in a world where inflation is rising in double digits in many major economies of the world, inflation is coming down in America. So once again, when reports resurface that Joe Biden is going to again address the economy post the US CPI print, the expectations have risen that perhaps it's going to be a softer than expected print inflation number coming out of the United States. And he is likely to be expressing expressing his pleasure at the lower rate of inflation. Well, that's about the US, and that's the big number that everyone globally is going to be watching out, because it will feed into the Fed meeting on the 31st of January and 1st of February. But let's tell you the other cues that we're tracking. Today is the weekly options expiry out here in India. IT sector is in the limelight. HCL Tech and Infosys are likely to report numbers between 4 and 4:30 p.m. Infosys presser scheduled at 4:30 p.m. Then the earnings call at 6 p.m. HCL Tech presser is at 6 p.m. and then you've got the earnings call at 7:30 p.m. and at 5:30 p.m. India time, you've got the India December CPI and the November inflation IIP data. So lots to track. All of it is going to come post-market as Nigel. So tomorrow is going to be a very crucial session for us.
Well, that's right. It's going to be a crucial last 60 minutes as well, Reema. And if you look at the intraday chart on the Nifty, the fun and games have started. We're getting to weekly expiry. We suddenly saw a 40-point uptick, but we couldn't hold on to those levels. So just looking at it, well, the Nifty breached that 17,800 mark multiple times today, but the bulls have still managed to defend that mark. So they feel that they're still in the game. However, the call writers, they're getting very, very confident, which may not be such a bad thing from a bullish point. I'll tell you why. 17,850 call, massive surge in open interest out there. The 17,800 call as well is seeing close to 50 lakh shares getting added out there. While on the downside, the 17,800 put is seeing some bit of writing, because even when the Nifty was at the low point of the day, well, you didn't have the premium go up too much. That's giving you a sense that the bulls, they are writing those levels. Now, given the premium that we're seeing at the 17,800 call and the 17,850 call, well, you just plug those numbers in. There's a bit of a resistance zone, 17,840, because the premium on the 17,800 call is around that 40-50 rupees odd. 17,840 to around 17,870. That's the zone that the bears want to defend. If we can trade above the 17,840 odd level for a goodish bit in these last 60 minutes, we'll see a bit of a bounce. For the time being, though, the bulls will feel they have defended that 17,780 odd mark on the downside. The bears, they are looking at defending the 17,850 odd mark on the upside. So interesting final 50-55 minutes coming up.
And there's going to be a lot of focus on individual names. Paytm is down 6% as 2 crore shares changes hands in a large block deal. Details coming up on the show. From the Pharma pack, Divi's Laboratory and Gland Pharma are on our radar as exports decline in Q3. IT heavyweights Infosys, HCL Tech due to report their Q3 numbers. Key expectations coming up on the show. We'll discuss the way forward for the markets and individual stocks with Sanjay Dutt of Quantum Securities and Shiv Sehgal of Nuvama Capital Markets.
Okay, well, how should you position yourself in the last hour of trade? Mitesh Thakkar is with us with exactly that advice. Mitesh, hi, good afternoon. Breach of those lows and a decent pullback after that. You've been calling for eventually lower levels from here. 17,500, I think you mentioned that earlier when we spoke in the morning. Your thoughts?
Good afternoon, Prashant. So I think, yes, that overall bias still remains negative. The only thing is that we aren't getting an proper hourly close below 17,800. I think, it's just piercing that level and managing to bounce back. What I've observed is that apart from the options data, which I think the analyst was just mentioning, is that the bounce backs from that level are getting lower. So I think that's not a very good sign. I think that still suggests that there is a more chance of a weakness happening eventually and a breakdown could fructify. So I think, we're trading with more stock-specific biases, and once we get a closing below 17,780, 800 on an hourly close level, then maybe you will initiate some short positions on the index. Having said that, previous motor is a sell call. That's a stock which is slightly breaking down, so turning mildly negative over here. A stop at about 1,021 can be looked at, and a target of 970 on the downside is what I think the stock can do in the near future. And Ultratech Cement is reversing very nicely from support levels. It's given a strong price volume jump on the intraday chart, so that's a buy. Keep a stop around levels of, or just below levels of 70.50 and a target of around 7,300 on the upside is what I'm looking at.
Okay, all right, Mitesh, we'll keep coming back to you. The final 60 minutes, as I said, it promises to be quite exciting. Look at the options data. Well, let's focus on the pharma space for the time being. Divi's Laboratory as well as Gland Pharma, they didn't have very good 2022, but 2023 as well has started on the back foot because exports have declined for the third quarter. Ekta joins us to fill us in with a quick analysis on both these two names. Ekta.
Thanks for that. Well, yes, Gland as well as Divi's are in focus on account of export data, which is in fact collated by the analyst community and assessed to give an indication in terms of what their Q3 sales or their quarterly sales might look like. Now, the export data, which in fact is collated this time and would be an indication about Q3, is looking a little weak. I'll start with Gland, where the export data is indicating a decline of around 14% on a Q-on-Q basis and around 12% on a year-on-year basis. So they generated around 654 crores in terms of export revenue this quarter, and that would be a decline both year-on-year as well as Q-on-Q for Gland. Now, drug-wise, the largest decline is in fact seen in a drug which is used for blood clots, which is low molecule weight heparin, as well as enoxaparin on a sequential basis. They did sales of over 230 crores last quarter. That's come down to around 97 crores this quarter. Another antifungal injection, year-on-year decline of over 70% year-on-year as per data collated. So they generated revenue of around 117 odd crores same time last year, and that's come down to around 27 crores this quarter. For Divi's, the export data X of molnupiravir is strong. Molnupiravir, in fact, has come down quite significantly. It's come down to around 20 crores this quarter versus 292 crores last quarter and over 970 crores same time last year. So there's a significant reduction, but if you remove molnupiravir, in fact, there is a rise which we've seen for Divi's, which should possibly bode well. In terms of numbers, it's up 14% Q-on-Q and 30% year-on-year. We don't know the exact correlation with regards to what it would reflect in terms of the quarterly numbers, but what we do know is that this particular export data is weak.
Okay, thank you very much, Ekta, for that. David, your read-through of Divi's as well as Gland Pharma from what Ekta had to tell us?
Good afternoon. Well, I think more importantly, the company has always maintained that I think they have got a steady order positions, I think order book positions for the purpose of exports in subsequent quarters. If any kind of disappointment comes, I think there is no room for the stock price to hold. I think that is one thing which is simply understood. However, as against the last quarter in the current quarter, I think some amount of stability should be seen on the margin front, which was missing in the last quarter. Though I do agree that I think somewhere probably I think one would have liked to see a higher amount of stability also on the export fronts of composites. So from that point of view, I would think that this quarter would probably be I think a little bit more cautious quarter. But as I count, I think many of the products are probably seeing the higher amount of visibility from the subsequent quarter onwards as far as I think the order book position goes. If that does materialize, then probably I think the trend reversal would happen. Up till now, I think the company has seen, I think, a fall in the exports. I think some amount of trend reversal could happen in subsequent quarter. More importantly, when we'll have to see the commentary coming in from the management in this quarter to get the direction right on the performance side.
Devin, hi, afternoon. What's ailing Reliance, in your opinion, Devin? It's come off sharply, right? I mean, 1st of December, price was closer to 2,800 and about 2,470 now. Your thoughts?
So, Prashant, I think my understanding is I think the index funds, the FPI trading funds, I think are basically selling continuously. And that is where probably I think some of the large cap heavy names are getting victimized. Reliance is no exception to that. I think many other counters which we can count, I think they are also similarly in the same bracket. In first 7-8 trading days of this particular year, I think we have seen about 23,000 crore worth of selling taking place from those FPI index funds. And that is possibly the resultant outcome of, I think, this market's fall in the frontline stocks. To me, I think the fundamentals of Reliance remains, I think, absolutely convincing and strong. In the contrary, in this particular quarter, we are likely to see relatively stable margins both in refining as well as in petrochemical segment, the core business. And of course, I think the far better performance coming in both in the consumer-facing businesses of Jio as well as retail. So from perspective of looking at the fundamentals, I think there's nothing wrong with the company. More amount of pressure is happening more because of, I think, this index funds are exiting India markets, and as a result of which, I think the larger cap stocks like Reliance is getting victimized.
Deven, earlier today there was a note coming in from Kotak, and they're going a little bit skittish on Nalco. So they downgraded the stock. They're talking about aluminum prices having some bit of a ceiling on top, cost pressures to continue, and valuation-wise post this recent rally, it's not very attractive. What's your sense on the non-ferrous names, particularly in Nalco?
So, Nigel, I think the demand scenario-wise, I'm not doubting too much, and I feel that I think the white metal demand scenario will remain relatively, I think, stronger going forward as well. Given the kind of India economy, given the kind of global economy which is now opening up, I think the aluminum as a material, but probably I think keep continuing attracting the demand. That is for sure. However, for Nalco, I think one of the other point which, apart from the prices, I think another point I think which bothers is the capex program which continues. And this kind of capex program, when the commodity companies undertakes, not only it results into the negative cash flows, but at the same time, I think they create the pressure on the margin till the time the complete capex program, in this case, for aluminum refinery, gets completed. That is one of the reasons for which I think the probably the price is getting affected, the stock price movement is getting affected.
Got it. All right, Deven, always good hearing your thoughts. Thanks so much for stopping by for a crisp chat today on a whole host of stocks that we just discussed. By the way, that pullback that we saw, that quick 50-point pullback, well, that's got sold into. Reliance Industries, the naughty one in there, moved to the low point of the day. And Kotak Mahindra Bank as well. That as well has dragged its feet a little bit. So that's moved a little lower as we speak. That 50-point spurt that we got from 17,800 to 17,850, that's almost given most of it off. For the time being, we'll slip into a short break. On the other side, we'll discuss the way forward for our markets. We'll get in a couple of guests who will be joining in with some stock-specific action as well. Sanjay Dutt will be joining in, and also we'll have Shiv Segal who will be joining us.
Welcome back. Things are getting choppy for our markets. At 1 o'clock, there was a fall in the markets. At 1:30, there was a recovery. Closer to 2 o'clock, there was a recovery. And then at 2:30, once again, the fall. So 17,862 was the recent high on the Nifty just in the last 10 minutes. So from that level, we've given up close to about 35 odd points. Sanjay Dutt, Director of Quantum Securities, is now joining us on the phone line. Sanjay, what's the read-through on the markets? Despite a positive handover from the global markets, the Indian markets are grinding lower year to date. The S&P 500 is up nearly 4%, while the Nifty is down 1.5%. Is this a sign of things to come?
I don't think so. One needs to worry about, what's happened in the last 10 days, the first 8-9 trading sessions of the year. It's too early to really pass a judgment about what lies ahead. But I think there continue to be individual opportunities among sectors and stocks in the market. And investors need to use, extreme weakness, extreme levels to basically accumulate. I don't see any reason why that changes as to what it was last year and the year before that. Stick to specific stories, indices, may just carry on and do nothing.
Okay. All right. Carry on. Keep calm and carry on, right, as they say. Sanjay, hi. Good afternoon. So what are your broad expectations from sort of this year? The budget is around the corner. Any thoughts on that? We're in the midst of the earnings season. There is this ebb and flow, right? These are, of course, regular events, but important in terms of the market calendar. Your thoughts?
I think the earnings are more or less in the price. I don't see much happening after the December quarter earnings are done with by end of the month. I don't see much of positive surprise coming in anywhere. Most analysts have got their estimates in place for the December quarter, barring aberrations, both negative and positive. So earnings won't have much of an impact on the market unless some very negative surprises show up. Budget would, I think, be a good document. May just turn out to be a defining moment, because I have hope, I have reasonably good confidence that the government would continue to put the economy on a growth path. We're just about coming out of post-COVID and the post-Ukraine events. Inflation is cooling off. So I don't see any negative surprises really in the budget. more so because we've just got about a year out for elections ahead. So the focus would shift primarily on what will happen in the budget and not that much in earnings as such. And obviously, individual company earnings ahead is what will drive stocks. Like I said, that indices may not do much in 2023, whether it's Nifty 50 or the sensex, but within mid-cap, small-cap space and some of the large caps, one would see outperformance.
All right. Hi, Sanjay. Thanks so much for joining in. Always good hearing your thoughts. Sanjay, everyone's been talking about China and the China reopen trade. Now, that's what's fired up our metal stocks. You have been bullish on select counters. I recall you talking about Hindustan Copper, Nalco, JSL Stainless. Well, that's a multi-bagger for you. Could you tell us what's the outlook on metals from here on? They've already had a good run. The index itself is up 15-18%. Your view on the metal stocks, what's still looking good at these levels?
I think metals continue to look good. I think this year you would see outperformance in metals. Another area which looks interesting to me is the oil marketing companies, IOC, HPCL. If you look at them, some of them are just trading 2 times or 3 times cash. If you look at an IOC with the EBITDA on a trading 12-month basis of about 50,000 crores, an enterprise value of 2.5 lakh crores in a market cap of just about 1 lakh crores, trading below book value. So I think there will be some re-rating coming in there, and more so because crude prices have cooled off, and I don't expect crude to really go back to 110, 120. So these companies won't be hit that badly. That's, I think, a good trade for this year, the oil marketing companies, and everyone's ignoring them at this point of time. No one wants to touch them. Similarly, I think some of the key FMCG stocks also, like an ITC or a Reaver, etc., may just outperform because input costs have come down, whereas the shrink inflation in terms of package sizes or price increases have been passed on. All of them are never pulled back once you have a price increase taking place. So FMCG margins will also improve if inflation starts to come off. So these are 2-3 pockets, metals, FMCG, oil marketing companies, where I think there is strength. Of course, the obvious ones, which will carry on with their capex and infra capital goods, even those select pockets are always there and will continue to perform there.
Sanjay, when it comes to ITC, and that's a stock which you said you like, there is that event risk of a budget. We've not had a tax on cigarettes for the last couple of years now. Do you see it coming? There are a lot of reports which suggest that we may have a tax coming through on cigarettes this time. And if it does, it will be a de-rating event for ITC, right?
Well, very interesting because I don't see any re-rating in terms of people wanting to come out with aggressive buy reports also come in because of so-called ESG issues. So I think that will really be a non-event. You just might see a dip and that will be an buying opportunity. Because if you look at ITC, irrespective of anything, the cigarette business, taxes or no taxes, would generate anywhere between 15 to 20,000 crores a year of cash flow. And you have the FMCG businesses, you have a lot of other businesses which are now stabilizing. I'm not saying they are gung-ho generating cash, but they're stabilizing. The brands have, pretty decently matured and has a good brand recall. So I think next year or two ahead will be good for ITC, and I'm also confident that there would be value unlocking there in terms of whether it's demerging the hotel business or whether it's something to do with the IT business. There is also talk of some bigger event happening in the company. So I'm fairly confident that ITC would be a buy in case, to answer your question, in case you get some aggressive taxes or anything and the stock dips. That would be a good opportunity to actually add some more.
Okay. All right. Sanjay, before we let you go, I recall when there was plenty of supply coming in on Zomato, you had a contra view. You went in there, I think you chipped in at around that 40, 42 odd mark, and that's worked out pretty well. What about Paytm or some of the other names? Because suddenly there's a lot of talk of supply coming in on Paytm as well. We had a large trade that took place just a couple of hours or so ago. Your take, has Paytm come to that level that you would like to give it a look, or you're avoiding that for now?
No, I don't think so. The difference between a Zomato and a Paytm is that Zomato is something that's quite ingrained into the society and into the Indian consumer psyche. And also, I think Zomato will become cash positive much earlier than Paytm or any of these people would. And then also the bigger problem with Paytm is that, most of them are dependent on their business volume on the, UPI business, where there's too much competition from Google Pay, Phone Pay. So I'm not that confident about a Paytm model versus a Zomato model. So I would stick to a Zomato. Maybe I would buy something like a PB FinTech, that's the Paisa Bazaar. Even there, I'm not that gung-ho, but I think within these new lot, Zomato is the only one which made sense to me, and it still makes sense to me to buy and hold on if anyone likes for a little longer term for their portfolio. Longer term meaning about 2 years from now and not 3-6 months.
Okay, all right, Sanjay, we'll leave it there. Thank you very much for your time. It's always a pleasure having you with us. We'll get you back on, around the budget as well, once the budget news flow and expectations, etc., get into full swing. Thanks very much for that. Well, the market's slipping again. We're down about 70 points. So 17,826 or so is what we have. The high was made, at about 225 or so. This is the high after the December 26th low was broken. But this is another leg down which we are seeing at this point in time. Will this go all the way, or will we kind of limit the losses here? Let's see. There's still, 40 minutes to go for market closing. Shiv Sehgal is joining us. He's President and Head at Nuvama Capital Markets. Shiv, great to have you with us here on the program. Thank you very much. Just give us a bit of texture, feel of what is going on in terms of, institutional flows. What are you picking up when you speak with clients? The one theme we've been pointing out is, markets, big underperforming markets of last year getting money. At least that's what we've seen 2 weeks of 2023. And money is it's being funded out of investments here. Is that what you're seeing? And what else?
So, Prashant, firstly, thanks for having me on the show. Always a pleasure to speak to you guys. I think a few anecdotes here. What we have seen is that 2022 was a massive outperformance for India, right? On a relative basis, we had the entire world, entire global market selling off, and India's domestic growth-led tailwinds really helped us. What is plausible here is that 2022 was a price shock, a financial market shock, but not yet an economic shock. I think the markets may have got ahead of themselves that it is the economic shock comes with a lag in terms of what the Fed has done, right? A lot of those effects will have a lag into 2023, and there are still a lot of unrealized risks for the real economy. I think the Fed still wants to be very clear that they're in control. Pivot too soon, the biggest question from a macro community in the institutional world is, when does the Fed pivot? What does the Fed pivot look like? Does it come in the second half? And how long does it last, right? I think there are a couple of interesting anecdotes there, because the problem is if they pivot too soon, you might set a rebound in growth expectations and inflation expectations and energy and other commodities. And suddenly the PPI goes up, the CPI rebounds, and then the Fed has to go even harder. So that might be the story for later in 2023, but it certainly feels like that's the playbook. So in my realm, I think it feels that, Fed will probably hike by another 25 basis points, see how the data plays out in the next 1 or 2 quarters. But what that does is the fact that we have China reopening at the same end. You asked this question just to your previous audience as well. And I think what is important here is we are seeing in the institutional world certain reallocation of money from EM asset allocators that are looking to invest into China. And they are, we have been seeing the data every day, foreigners are selling India. But structurally, I do feel that we are in a slight of a blip here in January and February. And to remind everyone kind of watching this show that we saw a similar trend last year as well, right? 2022, when we started, everyone was talking about the fundamental value in China. And we saw money rotate out of India into China at that point of time as well. Of course, as quarters and months went by, we saw that the domestic growth story, the no alternative, everything that we talk about from an India structural long-term bullish aspects remained intact, and we saw money rotate back into India in the second half. I think we might be seeing a similar playbook right now, and it seems to me that earnings are probably going to dictate in the short term in India, and we are seeing a little bit of headwinds in terms of what's transpired. I bucket them into 3 classes, right? We have the recession fears and impact on global demand at the moment. We have the QE withdrawal with high interest rates, and of course we have the geopolitical issues from a macro community point of view. At the same time, from the domestic scenario, what the few headwinds that we can talk about going into this year is, of course, we have 9 large states, 5 large states and 9 political states going into elections. We have general elections next year. We have potential re-emergence of imported inflation due to high commodity with China and the global growth opening up, right? And slowing demand scenario in India, which I don't think plays out, which strategists are calling about. But, coming back, I think a lot of participants have come here and talked about the fact that manufacturing shift is happening in India. We have unlevered balance sheets. It's the beginning of the private capex cycle. There is massive investment in infrastructure development, both from the government and private sector. And most importantly, the fund flows. The fund flows into emerging markets as they happen. So there are 2 legs to it. The first derivative is as China continues to see the first leg of the investments, we will of course see the outflow. The second derivative is as EM bucket starts to see more money. MSCI India, our share has gone from 9 to 14.5%. So we will be the second derivative benefit of that. So I'm not that negative with China reopening. I think it's actually very positive for India and for global growth that China does reopen. It's a very large economy for the last 3 years that has been shut. And I do feel that it's about time that we do see some impetus from China and added benefit to global growth from that perspective.
Hi, this is Rima here. This year is also going to be unique in a way that US and Europe is likely to slow down and China is going to do very well. So typically in the past when we've had recessions, all the global economies have fallen in tandem. But this time you've got 2 large economies which are going to be moving in diverse directions, in different directions. So this year is going to be pretty unique. Shiv, but before that, numbers coming in from Sign. This is a mid-cap IT company and it's not bad at all. In fact, it's beaten street expectations. So this would be the second number from the IT earnings pack, which has not been as bad as what the street was fearing. The revenue growth, we've got only the rupee revenue growth right now. We do not have the dollar revenue or the constant currency revenue growth, but the rupee revenue growth is 16%. Margins have expanded by more than 300 basis points on a quarter-on-quarter basis to 13.2%, and profits have practically doubled. The PAT has gone up 97% on a quarter-on-quarter basis. One reason why you are seeing such very large growth numbers in the case of Sign is because of acquisitions. There were 4 acquisitions that Sign did last year, which have all culminated, and the full benefit of that is coming through in Q3. So the organic growth is going to be, 3-4%, thereabout. But given the acquisitions that the company has done, the top line is looking very good. And another reason why the profit jump is so much higher at 97%, that's because in the prior quarter, there was an exceptional loss. So one reason is the margin beat, and the other reason is the fact that last quarter, the profits got depressed due to an exceptional loss. Shiv, wanted to get your thoughts in on IT. Not as bad as what the street was fearing, whether it's TCS and now even Signed.
So, Rima, I'm actually very bullish on the IT sector. I think, the sector itself has been consolidating. Of course, there was a derating in growth stocks globally, right? I mean, of course, because as interest costs went higher. But from an India perspective, I think there is a couple of combination of factors, right? One is we are seeing margining or bottoming out, right, in the entire IT space. I think it's a healthy dividend yield play sector as well. There are cheap valuations given that it's been in consolidation phase for the last 2-3 quarters. And additionally, from a macro standpoint of view, I do feel that there's a potential INR weakness coming that could be a tailwind for the sector as well. Let's not forget that INR was probably the best EM currencies for 2022. And there is a lot of the most important element that we didn't talk about is the fact that the order book even from TCS, even from Sign, and I think even Infosys reports later today, I think the entire IT pack is talking about the order book being very, very strong. And the margins bottoming out is probably providing a very good tailwind to this sector. So I'm actually going into this year quite bullish on the IT sector, for sure.
All right,
and, you also made a point on the mid cap and small cap space. Just one anecdote there. We all know the stats. Of course, the fact that Indian mid cap, not just IT, but Indian mid cap space has held up really, really well. If you look at what happened in the US and global market, and just take Russell 2000, which is the mid cap space in the US, that was down 22% last year alone, right? There are a couple of points which I don't think people understand to that extent. There is a tectonic shift that's happening. There is a market share consolidation happening from the unorganized to the organized sector that's been in play in India for the last couple of years. This shift benefits the mid caps far more than the large caps, as small shifts in the market share for the mid and small cap companies can result in much stronger demand and profit bumps, right? The other anecdote, and the data actually just came out recently, which I want to share, is that if you look at the amount of inflow that we are seeing from small and mid cap from the SIP flows that we see. So in December, about $880 million came into equity schemes last month, right? And if you look at what the share of small and mid cap was $500 million, right? That's about 60%. And what people don't realize is, I think, we topped out in Jan of 2018 in this particular space. We have been transitioning to a much healthy balance sheets, much more robust set of earnings. And I think that interplay is about to kickstart again. I remain structurally very bullish on India per se. And I do feel, I want to go on air about it, I think in the next 3 to 5 years, you will see an equity super cycle in India for sure. Of course, it's going to have its volatility along the way. But for me, at least for this year, I think you're going to see the small and mid-cap space do exceptionally well.
A very valid point, Shiv. Thanks so much for stopping by and giving us your view on the headline index, on how you see India versus China, as well as the point you last made, that the breadth of the market could still do well, even in volatile scenario. Thanks so much for joining in. By the way, it's expiry that's going to play out, and we're holding above that 17,850 odd mark. The 17,800 call writers, they're in a bit of trouble. So let's watch out now whether the 17,850 call writers, they'll be in trouble. You need the index to hold at these levels. It's been a good recovery from the day's low. So the last 30 minutes, last 20 minutes will be very, very exciting. For the time being, we'll slip into a short break. But before we do that, here's something that you, our viewers, must take note of. CNBC-TV18 and the National Stock Exchange, well, we have come together to promote investor awareness through a very special campaign, Informed Investor, that empowers you to make the right decisions with your money. Nothing in life is guaranteed, right? But many investors fall for the guaranteed returns gimmick. A smart investor always avoids investing in such schemes and is aware that they are illegal and must be reported to the exchange. Any investment in such schemes is not eligible for compensation from the exchange. Hence, it is wise to avoid investing with anyone promising guaranteed returns in the securities market. Take note of that. Welcome back. You're tuned into Closing Bell, and we are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, as we speak, that recovery that we're talking about, that's well and truly on. So now we're only down 30 points odd. You like it to sustain at these levels. You could have a quick fire, 20, 30 points in the last few minutes or so. So let's see whether or not that does take place. But for the time being, Nimesh is with us. Nimesh, what are you picking up in terms of flows? Are they improving a little bit? The FI flows continue to remain on the sell side.
So again, today it looks like the flows are negative, but unlike yesterday when there was a large sell-off, today is not. That's not the case, is what I understand. So the big chatter in the dealing room with regards to flows is that one of the leading hedge fund is a big seller in India, and that's the reason why I'm seeing such large numbers for the last few days. I guess maybe in the next few days that supply can come to an end. So a lot of people are talking about whether that fund is likely to finish the selling in the next few days. So that is a big chatter point as far as flows are concerned. But if you look at today's trade, while we saw a big sharp fall in the middle hours, it was on low volume. So it looked like it was a shallow fall, and hence you're seeing a bit of recovery as well. I guess the weekly expiry is also playing out. But technically, the good part is that we are holding on to that 17,800. That's a very crucial level from a technical point of view. I guess if that holds on, maybe you'll see a bit of covering as well, because looks like some of the large cap names are a little oversold. So that's the other feedback. The other interesting feedback that I got today as far as flows are concerned is within financials, there is a bit of a pair trade happening now. So a lot of funds are now buying into HDFC Bank and selling ICICI Bank. So ICICI Bank was a big outperformer last year, and HDFC underperformed, right? And now with the trigger of a merger going through, there is a bit of shift happening within financials from ICICI Bank to HDFC Bank. So that's another important feedback. We keep hearing about sector churn, so that continues today for a change. There is a bit of limelight in the cement stocks. All the stocks are buzzing in trade. But as I said, today doesn't look like a large sell-off from the FIs. But of course, the weekly expiry is playing out. Technically, 1700 is a very important level to watch. But I guess, but looks like market is slightly oversold. So some of the large caps may see a bit of a bounce back if there is a relief rally both globally and in India.
And Nimesh, I think even last weekly expiry, the Nifty saw a bit of a bounce back. So on Thursdays, it's coming to the savior actually of the bulls. Let's see whether or not we can hold on to that. But individual stocks, what are you tracking?
So in terms of individual names, the first stock today on my list is Chola Investment. That stock is buzzing in trade and on good volumes. I believe the reason for today's uptake is largely the selling pressure from a leading FI is largely over, and hence a bit of a bounce back in that stock. So that's the first one. The second stock is Divi's Labs. That stock is sharply under pressure today, down 3%. Ekta spoke about the export data and concerns regarding to that. But I believe there is a small selling flow as well from a leading FI. But for Divi's Lab, the other important trigger to watch, and that's been a big chatter as well, about a large capex getting approved very soon. So that could be a next big trigger to watch as far as Divi's is concerned. And the last stock is L&T, a bit of a defensive buying going on. Remember, before the budget, this is a best proxy play as far as capex is concerned. So there is a bit of buying back from the large institutions. And also, there was a JP Morgan note today, and they've raised the target price to 2,300. So a bit of buying is back in L&T, and hence that stock is buzzing in trade.
Okay, all right. Interesting names. As always, thanks very much, Nimesh, for those. We'll keep an eye. 50 points lower. So, I mean, I actually think it's swinging 30, 40 points just like that and multiple times over very quickly now. Mitesh is with us with what he would want you to do in terms of short-term trading ideas. Buy today, sell tomorrow. Mitesh, what do you have?
Prashant, the sell on granules STBT. Let's keep a stop at 320, look for targets of 310 here. And buy on Cummins India. I think that's something, which is closing with positive bias. So keep a stop at 1470, look for 1495 as the target for tomorrow.
Okay. We will be awaiting numbers from HCL Tech and Infosys post-market hours. So a quick run through what the key numbers the street is looking out for. When it comes to Infosys, it's a dollar revenue growth of 1.5%, constant currency revenue growth of 1.2%. This will be lower than what TCS had reported. Margin expansion is likely to continue, so EBIT margin seen at 21.9%, which is within the company's guided band, and it is an expansion for the second consecutive quarter. The bottom line is seen about 6,500 crore rupees. Do not expect any change in the FY23 guidance. That's what the market is expecting, which means revenue growth stays at 15 to 16% and margins between 21 to 22%. What will the street track? Watch for deal wins, watch for hiring, because these are the two areas where HCL Tech disappointed the street. TCS disappointed the street. TCS's headcount addition had come down on a quarter-on-quarter basis, and the deal wins too had moderated. So watch for these two internals, and as well as commentary about Europe, because TCS had called out that geography as being challenged. Infosys, valuations, as you can see, are not at peak levels, but they're not even at the historical levels Infosys is typically traded at prior to this whole post-pandemic digital transformation rush. When it comes to HCL Tech, well, it's unlikely that we're going to see any kind of surprise, because just last month, in December, the company had given out an updated guidance. So expectations have been reset based on that. So it's, in a way, the cat is out of the bag when it comes to HCL Technology. 3.5% top line growth, margins at 18.7%, and a profit jump of 10%. Again, unlikely we're going to see any change in the guidance, because only on 9th of December, the company had said growth rate for this year will be at the lower end of their guided band of 13.5 to 14.5%, and they reiterated their margin guidance of 18 to 19%. The stock trades at about 18.5 times, which means it's cheaper than what peers like TCS as well as Infosys are trading at, but it's largely similar to what Wipro trades at. Sudeep Bandyopadhyay, the group chairman of IndiTrade Capital, is now with us. Sudeep, I wanted to get your thoughts in on Signed, and if you had a look at what the numbers were. Prima facie, it looks like a beat. TCS's top-line performance was not bad. What would be the takeaway and the expectations accordingly which have been set for Infi and HCL Tech?
Well, I think, I have not been, totally bearish on IT. They have some challenges in Europe very clearly, and TCS did mention that during their earnings call. And I'm sure we will get to see the same narrated again by Infosys. Remember, these two wikis have about 30% plus business coming from Europe. So the guys having exposure in Europe will have a bit of a challenge as far as Q3 and maybe another couple of quarters, with Europe not doing as it was doing. But overall, if you are willing to look beyond that next couple of quarters, I think IT is a structural issue with large corporates and conglomerates with whom these Indian IT companies work, and I don't see any major shift in trend. So Indian IT companies will continue to do well in the medium to long term. Yes, they have a unique set of challenges in current quarter as well as probably next couple of quarters. As far as Infy is concerned, as you just outlined, I think what I'll be watching out for is also their commentary. TCS talked in detail about each of the sectors. I would love to see that from Infosys as well. Of course, their the numbers, which is the addition of employees or reduction, that will be carefully looked at. Deal wins is one thing which we haven't heard anything from Infosys in their their kind of update. Let's see what they talk about and what happens there. I think these are the things which will be watched. Beyond that, I don't think there is a major concern as far as any of the top IT companies are concerned.
Look at rate gain. It's just amazing the move that we are seeing. 6% again. And since last Friday's close, it's up 20%, right? I mean, today included. So this is, 4 days, and it's by the way, it's up 6.5 off the day's high. The day's high, of course, was, just look at this, 368. So it's about, 13 rupees off the day's highest point. But it's turning out to be a pretty incredible week, all told.
RateGain is not your traditional IT services company, right? It is a new age tech company. It's a SaaS player. So as we've seen re-rating of these global denominated tech companies in the US, the NASDAQ and the individual constituents of NASDAQ have had such a fantastic run. We've seen a similar re-rating or an up move. Not re-rating is not the right word, but an up move coming in RateGain, because RateGain is ultimately, a SaaS company. It's a platform company, and that is getting, it's enjoying the rising tide of these, new age tech companies and the global tech companies. And RateGain is profitable, of course.
Yeah, no, absolutely. I think there was a brokerage initiation as well. Anand Rathi, I think 2 days back.
400 plus was the target price that they set out.
So it's done well. Sudeep, do you track this one? Any thoughts?
Yeah, absolutely. I just like to add to what Rima was saying, is that they are also in the right sector. There's a revenge travel, tourism. RateGain is in a particular space where I think they are catering to these segments. And the segment they cater to is doing very well, and it's expected that this China reopening also will see that revenge travel and things like that. We already are hearing reports of that. So I think it's good time for RateGain, and being a SaaS company, their revenue also keeps going up when there is significant increase in volumes, which is passing through their platform. So it's absolutely kind of rightly positioned as of now. And that's the benefit they're reaping.
All right. Sudeep, stay with us. There is 9 minutes to go for close. We'll have to take a quick break. But as we take that break, here's important information for our viewers. Don't miss out on the 19 must-have stocks for 23. Subscribe to Money.
Well, welcome back. Well, let's get straight to a big CNBC-TV18 exclusive. Sources say that the NCLT may approve the PVR-Inox merger today itself. Well, Nimesh joins us to fill us in with further details. Nimesh.
Hi, Nigel. So, what I understand from sources, there was a final hearing in the Mumbai NCLT today, and the oral, order has been pronounced by the judge that the merger is in principle been approved by NCLT. Now, the written order is expected in the next 15 to 20 days. So, that's the next step. After the written order, there will be official communication to the exchanges, and over the next, say, 1.5 to 2 months, the merger will finally go through, and it will be the one entity. So that's the word that the Mumbai NCLT has today given a final approval to the merger between Inox and PVR. If you look at the announcement which was made a couple of months back, the ratio was every 3 shares for PVR for 10 shares of Inox. So that was the merger ratio. If you look at the price today currently, it's pretty much in line. So it's actually capturing the merger ratio very nicely. There is no arbitrage between any of the stocks. But the merged entity now will have a market share of at least 40% in the top 7 cities. So it become a huge force to reckon with in the exhibition industry. So that's something to track. And I guess that was a big trigger as well. If you look at the research reports of most of the brokerages in the last couple of months, they all have been highlighting that apart from the numbers, which are expected to be weak because it was a weak quarter, but the big trigger for the stock is the merger between Inox and PVR, and that looks like is now finally been done. NCLT Mumbai yesterday, in principle, given a go-ahead for the merger, and the written order, what I'm told from sources, is expected in the next 15 to 20 days.
All right, well, big news coming in there. Sudeep, both these two stocks, they moved to the high point of the day as we speak. As Nimesh said, they'll have a far larger size and far larger market share. Your view on any of them?
Well, I think they are definitely good plays, and this merger is what I think pretty much the companies as well as the market was waiting for. With this order, assuming it is coming, I think it's a great news for the shareholders of both the companies. We can look at completely different levels and a re-rating of the merged company. Of course, exhibition business is volatile, and investors coming in will have to remember that they have to withstand some amount of volatility. But the way the lineup of movies are kind of there, it looks like, I think, next couple of quarters should be good. And that's the assumption. Of course, they will have much more bargaining power as a combined entity, and that should augur well for their revenues.
Okay, all right, Sudeep, thanks so much for giving us your quick comment on that, and good speaking to you today. Well, Nimesh, you have some few more details with regard to what this merger means?
So I was just looking at some brokerage reports on what the merged entity will look like, and what are the shareholding patterns of both the promoters and also. The merged entity will have a network of more than 1,600 screens, and they aim to add at least 200 screens every year. So that's the kind of 1,800 screens that they'll have in the large metro cities. Now, in terms of promoter, both the promoters will have board seat in this merged entity, but the Inox promoter will have a slightly higher stake. So they will own close to 17% stake, and the PVR promoters will own 10.5% stake. So that's going to be the promoter holding. But in terms of size, they will have a screen presence of over 1,600 screens, the merged entity, and they're looking to add at least 200 screens every year after the merger.
Okay, all right, Nimesh, thanks so much for that. So both those two stocks, well, they go home with strong gains today. Well, time to wind down then. It's been a volatile trading session in trade today, but it seems that the weekly expiry came to the rescue of the bulls yet again, because we've recovered close to around 100 points from the low point of the day, and we're going to be ending closer to around the 17,860 odd mark. A few stocks that did well today from the Nifty pack itself, well, just to name a few, you had SBI Life that was up, Ultratech Cement was higher, L&T as well was higher, all of them gaining between 1.5% to around 2% in trade. HCL Tech going into its numbers strong with a gain of around 1.5%. On the flip side, big boy Reliance Industries a little lower with a cut of around 2%. BPCL came for some profit taking with a cut of around 2%. And Divi's Laboratory didn't have a good 2022, 2023 as well, has started off on the back foot. But plenty of movers, guys, in the mid-cap space as well.
Yeah, I mean, there are movers. And, 1,200 stocks are lower and about, 1,000 and 1,050 stocks are higher. Let's just look at losers first, because market breadth is slightly on the negative side. You got the big one, which is, of course, Paytm, which lost about 6.5%. Volumes, I mean, huge, of course, because of those block deals. Nykaa is down 3.5% at close, and again, volumes are very large in Nykaa. There is Divi's Laboratories at number 3 position. It came up very sharply from the day's low, 33.07. Gland Pharma lost 6%. The stock's at about, 1,500 or so, just under that. Granules India was down 4%. I think Mitesh had Granules up as a trade. Stovecraft 4.5% lower. Stocks at 500 flat. JK Tyre lost about 2 3/4. Jindal World 8% lower, coming up with decent sized volumes. Goa Carbon was down about 4%, and so on and so forth. So lots of action in the broader space on the downside, and a lot of stuff higher, of course, as well. Naveen Fluorine and a bunch of names which did very well. Cyient, which reported towards the close, Rima, did quite well. Stock ending about 5% higher.
Yes, there was a margin beat for Cyient. So Cyient ends with a gain of close to about 5%. But apart from that, rate gain up 6.5% today. Since the beginning of the year, the stock has rallied nearly 25%, and that's been a big mover. And Nazara Tech had a bit of a spike in the dying minutes of trade. Apart from that, you had gains coming through on Railtel, RVNL, where there is that order win. The stock was up close to about 5%. NFL, That gained nearly 5% in trade. A couple of these Adani Group stocks like Adani Total, Adani Transmission, higher in trade. Bank of Maharashtra ending in the green. There goes the closing bell. 17,863 was the final tick on the Nifty, and that was a full 100 points higher than the day's low. By the end of trade, it was just a modest cut of 32 points in the Nifty. That's down less than 0.2%. On the sensex as well, just down close to about 0.25%. So we came off very significantly from the day's low. But it's an action-packed evening lined up with earnings coming through from Infosys, HCL Tech, as well as important macro data, December CPI and the November IIP. So don't go anywhere because we'll be tracking all that. And plus, Tata Motors has unveiled over 20 new offerings at the Auto Expo 2023. Excerpts from an exclusive conversation with the chairman N. Chandra coming up after this very short break.